the U.S. Treasury is encouraging commercial banks to do something that would upend how credit creation is done in the U.S. I think Matt, I had sent this late last night. I found a couple of notes from Besant, but I'd like you to kind of go through exactly why this is such a big deal for the credit creation in the U.S.
Yep. Um, oh, this is just to cut to the chase here. This is just the sixth time. How many times does it take a message to land with a recipient to sink in, right? You say it once, all right, did you hear me? I'll say it again, did you hear me? If I say it like 10 times, I've been saying this for the last like 5 years, eventually you expect everybody to get on the same page,
Yeah.
hit the marching orders, everybody act together. That's exactly what's happening here. So what are the marching orders? All right, this was a roundtable luncheon in Washington, D.C. held on Tuesday. Basically, the who's who was there. This Committee on Capital Markets Regulation. It was spun up by Treasury Secretary Hank Paulson in 2020 or 2006, 20 years ago. Uh, as the writing was on the wall, people saw the GFC coming. They saw that there was going to have to be capital markets reform. Um, this working group was spun up with basically the captains of industry for the financial markets as they relate to the United States. You've got the big banks from the U.S. represented. You've got all the regulatory, alphabet soup. Everybody's there. You've also got a couple of international banks. So there's some Japanese bank. There's I want to say ICBC from China has a rep. You got some European banks coming in. But basically it's like, all right, how is the new credit system going to work? How are we going to regulate and get out of this? I guess just call it just muddy sledding that we're operating through right now, which we've really been in for the last 20 years, right? And so the paradigm that's really coming through, instead of a framework where new money creation is primarily viewed as the responsibility of the Fed. And what do I mean by that? It's like it's a QE framework, right? If the economy demands more money, we need to get more money in the economy for growth to take place, right? This is kind of the monetarist framework. It's going back to Keynesian, neoclassical economics that dominated the 20th century. The paradigm that stepped in, and this was really the central banking, that they're the be all and end all. They're the masters of the universe. That whole kind of belief structure. Basically, the policy prescription was exactly what we saw in the 2010s. The central bank is the one who has to come in through QE to reflate, remonetize, say a growth downturn in the economy to pull it out of the bust part and get back to the boom of the business cycle. All right. That whole framework has been thrown on its head. We're essentially trashing the Ben Bernanke or Japanese central banking experimentation policy view, and ECB went along with it as well. That's being thrown out the window now. And this is really represented in the nomination of Kevin Warsh, who is a balance sheet hawk. The idea here is what's going to happen. We're going to shift the Fed and the central bank back to being the lender of last resort. In short-term money markets, commercial paper, et cetera. They'll provide the emergency liquidity into the banking and financial system, through they'll create money by say purchasing treasury bills or short-term commercial paper. That is money creation, right? But it's really happening. It's monetary creation, not for, let's say, the government itself or not for the broader private sector economy. It's money creation for the banks. And then what this is saying is the banks need to get back to their role of lending and creating money into the private economy. So basically what Treasury Secretary Besant and Undersecretary Jonathan McKernan delivered in these remarks is basically just what we've seen multiple times now in releases from, let's say, the Fed, et cetera, over the last few years. We're moving the discount window. They're setting up this architecture where the collateral assets, so say a bank loan or yeah, a mortgage, et cetera. Those are pre-registered. They've already been reviewed. The Fed has some data on these assets. Um, Before the crisis, goes to DEFCON 5 or, whatever, we're in the thick of it, where time is of the essence. All of these things are pre-registered, custody channels, other encumbrances. They've all been worked out. They know these things are free and clear, so that the lender of last resort can post. They know, and for the policy prescription under Badget Classic, right? Lend freely against good collateral at a high interest
All
rate,
about
right? Or a
speed,
penalty
right? They
at a
know
penalty
that
rate.
these
Yeah,
meet the
yeah,
requirements.
it's speed. It's get back to that, right? We're not going to solve our way out of this by QE. So the banks can recapitalize them or access liquidity. The collateral is pre-positioned, um, and that borrowing, that lender last resort placement can take place very quickly, and is not necessarily stigmatized. It's used for its exact purpose, rather than shunned. Now, then, what takes place after that? The expectation is, if you build out that system, then you can prod the commercial banking layer into bank credit expansion, which is actually monetary creation for the private economy. And this gets into, all right, here's money supply in the economy. It can come from two sources, right? Central bank can buy government bonds. They can buy whatever. Like you've seen examples in Japan. They're buying equities. They can buy land. Any asset, just as long as the central bank acquires it, gives money for it, they're doing that. They're accomplishing that task of increasing money supply. Um, but what we've seen in the US case, especially since 2008, banks have been reluctant to grow bank credit in the US. So that bank credit line lending and monetary expansion into the private sector is growing at 4.36% annualized. That would actually include treasury securities too and agencies. So this includes like private and public expansion. Um, the central bank balance sheet, and that's the dark blue. I don't have the growth rate there, but it's growing basically since 2008 at like 15% annualized. The point here, we're setting up a framework to basically shift those, right? We want to get the bank expanding money supply, funding growth in the real economy, and then pull back that usage of the central bank balance sheet for reflationary purposes, which, I mean, you look back at the last 10, 15 years and you see, all right, what projects did that fund? Software, SaaS,
Yep.
all of that, private credit. You're seeing a lot of that, like that's getting liquidated right now.
Yep.
A lot of that was bad debts built up. And so that monetary expansion, uh, the debt for that went to non-productive uses as it's turning, or a large share of that went to non-productive uses. Um, Instead, right, with this new framework that this administration is pushing is going towards reindustrialization, build out of infrastructure, et cetera, commercial lending. We talked about this in the H.8 data, but this whole pivot, this re-architecture, basically this thing, like we got all the who's who together. Treasury Secretary, basically, Treasury Undersecretary, basically delivered, guys, let's do that. Like we're doing this. So it's kind of that standpoint. How many times do you have to say something before someone understands and everybody gets on the same page? Well, everybody's heard the message now loud and clear. And you kind of got to expect everybody's going to start, falling in line behind, I guess, Treasury Secretary Bessent as the guy who's calling the shots. And this is the path we're going with. All right,
Yeah.
last story, Cameron. Let's get to it. Big news. This probably only was picked up on the radar of the Bitcoin space, or we'll include the crypto bros as well if there's any of them left anymore. But Kraken received its permission, or the green lighting, if you will, to register and open a master account with the Federal Reserve. So it's its regional branch. The Federal Reserve Bank out of Kansas City. So the way this works now, why is this important? From a plumbing and infrastructure standpoint, what this means, instead of Kraken as an exchange now having to work through one extra hop here in the domestic dollar financial system. In the old world, before it had this charter for the Federal Reserve Master Account, to transact and settle in dollars, it would have to go through like a commercial bank intermediary, right? A third
Middleman.
party.
Yep.
Yeah, and to basically to provide that banking service to a party like Kraken, a crypto exchange, right? They had to fund this through their own balance sheet, and essentially they're operating a toll road to ultimately access the dollar system rails. How does that materialize? Well, think about a transaction settlement. You're buying, selling crypto. If you're an institutional borrower, right? If you want to move dollars from your Kraken account, those IOUs, move them to your up to another brokerage to go buy, I don't know, Google shares, whatever. You've got to do hops, right? You got to move through the dollar financial system. The banks, their commercial banking partners were charging a toll to access, those roads, if you will. So you think about this moving through FedWire. I've seen wire charges of like 10, maybe even as high as $25 to do a wire transaction. All you're doing there is settling on the FedWire dollar. For a bank, that I've seen estimates that to conduct a wire, essentially, get on Fed chain. Um, that transaction can, like, they're very low price for the Fed makes it very low price for the commercial banks. So they can be as low as 3 cents, as high as, like, I don't know, maybe a dollar to conduct a transaction. But the markup there, that's bloated out 10x or 25x for a crypto firm like Kraken, to access those dollar rails and interact with the rest of capital markets. What it ultimately results in is non-competitive cost structures for Bitcoin or crypto industry firms. Case in point on that one, Cameron, I think you put it up here. Fold. This is a Bitcoin financial services company. Basically, it's just focused on giving rewards to customers who use, the Fold debit card for their daily, I got big dollar transactions, right? And case in point here, you look at their income statement. 2025, this is first 9 months, ended September 30th. So Q1 through Q3, $22.6 million in revenue. The banking and payment costs were 20.9, almost 21 million of that. So if you think about this on your gross margin structure, 92 and a half cents of every dollar you earned is basically just taken over by the troll who's operating the toll road, right? It is very hard to do anything as a business to get by that troll. Like Cameron and I, we're running a private sector business. Like, if you have, like, we have our own kind of trolls in the asset management, broker dealer complex, all of that. It is what it is. But if if you're if you're paying 92 and a half cents of every dollar, or 2024, same period, it was 94 cents, even worse. It's really hard to build up, net income, reinvest in the
Yep.
business, and grow. So this kind of, I guess, just what would just call it, restraint of trade, blockage, lack of plumbing access for the Bitcoin and crypto industry. This was extremely costly, right? So the Fed, through the Kansas City regional branch, greenlighting this. In my opinion, what they're saying, number one, the U.S. from a financial system perspective, they're not going to simply let banks just sit idle, rest on their loyal laurels, and rent seek through this little period. I talked about this growth patch we've been in, this soggy patch, tough mudding since basically 2008 in the GFC, and capital markets volatility. Talked about everything going on in international trade, right? When you see all this risk going on, what you want to do is just sit back. It's like, I just want to survive, right? Um, the US kind of regulatory structure, the Fed, political and governance, et cetera, everybody's now kind of, you're seeing them align that the legacy banking model, called banking classic, is Number one, with that Besant story we highlight on, they're going to have to lend into risk. Like they're going to have to capitalize this growth. That's the only way out of this. Um, and that angle that will ultimately lead to like more capital provisioning to the domestic U.S. economy, even its Western Hemisphere partners, who it wants to build up those primary and direct trade relationships with, and then its cooperative partners from outside the Western Hemisphere. That's the focus now. And then from a technology angle, um, it's basically saying like banks and the legacy system are going to have to come along and adopt what this crypto phenomenon is actually pointing to. And once you feel out the elephant in the room, right? If you look at Kraken, what does its business amount to? Number one, you've got the FX trading pair for the spot market, Bitcoin on chain, on the heaviest chain. Bitcoin is unique in what it offers as a digital asset, the solution to the Byzantine generals problem. We talked about that before. That's your primary business, right? You get into Bitcoin is what the market is saying at once. But number two, it's alternative chains and what they represent. What is their value prop? They're just running the stablecoin rails for the tokenization of US dollar bearer claims, right? And then underneath the stablecoins, what's actually the thing pulling itself up by its own bootstraps? Well, it's the treasury bills that are going to be plugged in. So now you're going to have a treasury as a monetary issuer in some regards, like the Civil War greenback, that'll probably compete to a high degree with the Fed's bank dollar framework or a credit dollar framework. Those two things will have to compete with each other in the years and decades ahead. But then what they're really accessing is the kind of that liquidity pool in the spot pair that Bitcoin represents. So that's what's going on. Stories 2 and 3 focus on the US angle of the build out of the new world. This is the hot business franchise that I think if you're putting it in that Sears Amazon analogy of the 2010s, which that's where Cameron and I met each other. Everybody, to tell you the backstory, Cameron and I met. We were building out the advertising kind of ecosystem to bring vendors on to Amazon's platform. All right, this thing in the Western Hemisphere, the Donroe Doctrine, the new financial rails, the new trade routes, all of that. That's the new sexy growth startup. Your old world, everything we're seeing, international trade, breakdown in maritime insurance risk markets. That's your Sears, in my opinion. What's the right move? Cut your losses. Stop working on Sears as soon as possible. Stop throwing good money after bad.